Hello, and a massive hello to everybody. Hope everybody's having a great day wherever you may be, whatever you may be doing. This is 50 Pips, rocking and rolling here on the 25th of March, 2018. No trade calls, no recommendations, or response for their own stuff. We're here for educational purpose only. So let's get cracking as we go into a shorter trading week. Holidays, markets closed on Friday, so U.S. markets closed on Friday, right? So 4 days, we'll have to see how it goes. A lot of geopolitical risk across the board, a lot of things shaping up, so we'll have to see what happens. I'm not going to talk about all that stuff. I'm just going to focus on the charts and try and keep this quick, but there's a lot to look at, right? So our base case on the equities was that we had to go back and retest the lows, right? Jan-Feb lows. And basically, the way we tried to, the roadmap we left up on the blog and we kept on posting was of the ES, right? And what we'd said was that as long as the ES did not have a daily close above the 2800, our base case was still intact, that we were going to come back down and test these lows and break lower and go towards the 2450s. Now, we also said that if we had a daily close back above the 2800, our hypothesis would be seriously tested, and that most likely we'd have to go and try and take out those highs, maybe print new highs, so this would pretty much be a no-go. So you could argue that either we were saved by the bell or that we had the right level on the chart. It's up to you to decide. Right here, so again, nothing much going on. The way this is trading, well, we expected it from here that these lows were going to get tested. We thought very surprising that this kind of action, the way it unwound, it was done and dusted. So here, even more so, we expect these lows to get tested. So again, markets don't only move in one direction, so it doesn't have to go through a straight line. Here, most people will be expecting a down open. We'll have to wait and see. But basically, if we open down heavy, 2600 is going to be the resistance for the follow through. If we break above and if we base around this 200 sometimes early in the week, as far as we're concerned, any move back into the 2700, which is going to be the confluence of the 50 DMA and the 100 DMA, is going to be a sell for a move back lower. So as far as we're concerned, all roads lead lower. It doesn't have to be in a straight line, but we expect the roads to lead lower. Our primary target on the ES doesn't change, around 2450s. Extension target is 2350s, 2310s inside this zone. So no big change. Now, what we've been talking about a lot in the blog posts was basically how tech broke as far as we're concerned, for a number of reasons that we highlighted in the blog post. What's really interesting is when we put out blog posts which are only text without the charts, they have the fewest amount of hits, but usually they're the most important posts, right? But anyway, that's just the way it is. So if you look at the NASDAQ, and a lot of the tech names have broken, but the easiest way to look at it, and we talked about this as it was happening, basically, if you look at it in the NDX, right? So we came back, that strong bounce here. We came back into those highs, rejected, and then we closed just ahead of those highs. And what happened? Bam, we gapped up, ripped it through those highs, and what happened? We couldn't hold that. We came right back down, and the market was trying to hold it exactly where you'd expect to try and hold it, right? Previous support, previous resistance acting as support, and key tests. And what happens? Bam, we gap down. So gapped up through that level, gap back down, leaving us a little island here, right? Well, we said once you see this kind of action, it's extremely rare that you do not probe the downside. These tend to be not very usual to see this, fairly rare, and especially in this kind of location, you'd expected very, very high odds that at the very least you would test these lows. But because of location, because of the pattern, because of the way it traded, etc., all these things we've been discussing, pretty high odds that you have to come back and clip this area. Now, that's in line with our outlook, was in line with our outlook that the way this traded, we had unfinished business around here, that this would not be the low of the year. So again, everything is pointing to the same thing. And you see a lot of these very, very heavy patterns across the board. If you look at something like Google, pretty much we talk, double island kind of pattern here. You've got, not to mention Facebook. As we said, the first day we broke, there's no way you want to buy this. This is potential move all the way back into the 100s. This is just completely broken. It'll rally sooner or later, but this is broken for a number of reasons. Don't want to go through it here. It's just too long of a discussion. Apple back through. We expect to see at the very least that 200 tested, but we're looking for these lows to come back into play. Amazon, very, very heavy on the weekly. That broke hard. If you go and you look at all these companies that have been propping everything up, you look at Boeing, extremely heavy here also, right? So again, it just looks like there's a lot of pressure here, so any bounce will likely get sold. So let's see what we get here. Another thing we were looking, before I forgot, got a tweet asking me to look at crude. Well, crude basically for us is fairly uninteresting in the sense that nothing really has changed, right? So what we were looking for crude is, as we're at these highs, we felt the positioning was stretched and we're going to see a little bit of a pullback. And on a move back below this key weekly level, we were looking for a move all the way back into this confluence of the moving averages into the 55 mark. Now what happened? We got a nice little tradable move down, and then it based and started to rotate higher. What we said is you have to look at this, basically this line, as a bull bear line, and you saw what was happening. You got this kind of triangle formation here. And once it broke higher, as far as the way we look at the market, what we said, there's absolutely no reason to stay short here. In our opinion, and we may be wrong, but the way we look at this, the only way you stay short on that kind of break is if you have a bias, right? The break is indicating that there's very high chance that we're going to go back and test those highs and possibly even rotate all the way back into the 70s, move up in extension. So there's no reason, if you want to look for shorts, you're waiting. Once you get that break up, you're looking for shorts higher. You're not blindly selling into strength, especially not on crude, especially not on the Friday, et cetera, et cetera, et cetera. So again, here as far as crude is concerned, as long as we hold this break higher, very least we're looking for this level to get tested. Failures here could be a nice short-term short opportunity, but as long as we don't trade back below this weekly level, this could just still be coiling all the way back for the 70s. So that's the way we're looking at crude. And again, if you look at those equities, we'd also be talking about the global picture, right? Everything's been very, very heavy. You see how basically we've got here on the DAX, this is extension move back down, very, very heavy. We expect this to continue lower. If you look at something like the Nikkei, this is also completing a move lower. We're looking for this to come all the way back down and test these lows. So markets are very, very heavy. Remember what we talked about in the blog too, in one of those famous only text onlys, that the buy the dippers have been conditioned to basically buy, and it just keeps on going higher. And one of these days they're just going to open down and they're going to stay down, right? And there's going to come a point where there's enough pain that's being done that the buy the dippers are just not going to show up anymore. So the big question is, at what point has the market done that much damage, right, that it scares the buy the dip crowd away? Now here, if you look essentially, right, this is where we opened the year. So anybody we're below that, right? So anybody who's been bought this year, or holding since the open, is down on the year. So it's not looking too pretty. However, if you think that this is just all wheeling and dealing, if you're conditioned as a buy the dip mode, I suspect that the feeling is still going to be that this here into the 200s is a gift from the gods. A move back into here when you thought you'd missed it because we're going back to all-time highs, this is an absolute gift from the gods. So what's going to be very, very telling, and I would say as much as, as long as this whole area here holds into the primary target, right? as long as the buyers show up here, we could be forming a very, very strong bottom, right? And maybe it might be a bounce for then going back higher, and maybe we get a chance to get back short. But if this is where you expect the buy the dippers or the bigger trend money to come and put money to work in and step back in. So the only caveat would be is that if we go into this week and you do not see any bids appearing here, and we start to trade below this trend line, and especially quick, then that's going to likely things are very, very ugly. And if we see this trade heavy and hold below, we're going to go back to our base case, which is ultimately November election day range has to be tested. We have unfinished business, because our humble opinion is that this is, a BS move, right? In the sense that, hope on no real fundamentals. However, we don't trade fundamentals. That's just something that we have in the back of your mind. We're focused on technicals, right? The fundamentals are just for chit chat around a beer. So let's see what happens. But that's essentially what's going on. The other thing which may be or may not be confusing a lot of people, and we've been getting notes on the blog, is about, what's going on with the DXY? What's going on with the DXY? Well, we're going to be fairly boring. And, since February, say nothing's going on with it. DXY, essentially, right? In the bigger scheme of things, we're still stuck inside this range. So until we get something, you can argue, you can complain that FX is not participating with equities when equities are not participating with FX, unless we get something big enough, right, to break us outside of this DXY range. We feel that any move that may come on whatever asset class will likely be contained or faded. If the big step change is likely going to be when we break outside of this range. Now, however, you have to understand and you have to accept what the predominant trend is here. And it's still that the DXY is heavy. Moving averages lined up, right? We're still holding below the 50. And even the fact that we couldn't manage to rally, on FOMC, etc., is telling. How's it going to play out? We don't know. But the fact that it couldn't even rally on, all the talk about more rate hikes, etc., it's quite telling. So would it be healthy to see a little bounce? Sure, but it doesn't have to come. And everything is looking fairly heavy, right? Especially if we trade below here, there's a good chance we'll go back. But ultimately, we're still stuck inside this range. So don't make it harder than it should be, right? Don't be showing up to the office every day expecting a hardcore 3, 4, 500 move on any of, on Euro, cable, etc. As long as we're stuck here, market's likely, we need to break outside of that range, right? And this is telling you we're still stuck, but with a dollar trading a little bit heavy. Now the big question is, and we talked about this, as far back, I can't remember when we had that interview with Dale ages ago, that the big question is going to be, if equities get extremely heavy, is there a point at which action on the equities is so ugly that the dollar is just going to get a bid because of risk off flows? That's something we've been contemplating for a long time. But again, don't make it harder than it should be. Let the chart guide you. And also for those questions coming in on yen and saying there's not that much to do on Forex. Well, there's been plenty of stuff to do on FX. It's not been as interesting as usual, but there's been stuff to do, right? Here you had a strong break on yen, and so far the move's still in play. As we said, as long as this break holds, we're still looking for this to extend back towards the 100. So this has been very tradable, right? Especially intraday. On every time the equity started trading heavy, you had plenty of chances to step in and fade these moves, right? It's been moving down, fairly orderly. Like there's been plenty to do here. And also another one where we had a nice little move was on CAD. Right, we talked about the fact that this was moving aggressively into this descending trend line, and that market doesn't move in a straight line. We had a real aggressive move, and we said heads up as we approach this trend line, right? And you had beautiful opportunity to short this for quite a decent move down. What do we mean by a beautiful opportunities? Well, essentially we're moving back above that line, and look at that. You've got 2 days where you're stuck in a very small range, giving you the chance to play a hold of this upper side of the range for fairly tight stops for the roll, right? So again, this has been fairly tradable too. So there have been things to do. I think it's been tricky if you're trying to be too smart about it. I think if you're trying to read all the correlations and look at everything, it's a little bit, you're making it harder than it should be always. But especially what we tend to believe is that when it's always easier to look at each chart independently, but especially when you're getting at points in the market, when you're starting to get dislocations, when you're starting to see things break, but you're at major turning points, it is fairly rare that everything moves in sync straight away all the time. You tend to get these dislocations, right? When this stuff sells off hard, everything gets sold off irrespectively, as counterintuitive as it may be. You'll get euro down, yen down, gold down, everything down, right? That's just the first phase, and then things settle, and then the usual safe haven bids come in. But again, before the moves really get traction, and a guide should be the fact that you see you're still stuck in that kind of range on the DXY, right? And broadly on equities, we still haven't really broken up or down hard, right, since the beginning of the year. So in these areas, there tends to be a lot of dislocations. There tend to be a lot of markets. Some markets lead, then some lag, especially if you're looking at the action on Russell versus NASDAQ versus a YM. It's hard. So don't make it harder than it should be. And but stay awake, stay focused, because there are opportunities around there, okay? Again, the other thing which is interesting is also the bonds are very telling. A lot of people saying there has to be a squeeze on the bonds have to squeeze, especially after the Fed, et cetera. The fact that even on the equity trading heavy, they couldn't manage to really take off, that's also a sign of where we are at, right? So let's see what's going on. A lot of interesting things ahead. It should be an extremely busy week, not to mention the open here. Have an awesome one. Thank you so much for liking. Thank you so much for sharing. Don't hesitate to reach out if you want me to post any chart or anything. And again, let's see what we happen. Should be a very, very interesting time ahead. Take care, guys. Bye-bye.